Well, let's get straight into it, because looking at the headline numbers, revenues up 1%, operating profits up 2%, and then a slight decline in those headline earnings per share coming through as well. Things looking pretty flat at this stage of the game. Your assessment of the period that was?
We're very pleased with the results, actually, for three reasons. We're coming off a base of a loss in our last full year's earnings of over 8 cents, which was the first loss since the company was established in 1996. Secondly, we restructured the mining business. That took some time. We started off this reporting period quite slowly, but we got the ball rolling, and now we're going full steam ahead. And thirdly, all the negative and unwarranted publicity we had with spats with suppliers. So we're actually quite comfortable, and we're looking ahead to what we're going to earn for the year. So we're quite comfortable with it.
Let's run through some of these defined operational goals and strategies that you've implemented through this period, because you say that they've been paying off. What exactly are we looking at?
Well, going forward, the company is predominantly going to be a mining company. We're looking at taking our existing resources, utilizing the existing resources to get the company at sustainability. We're also looking at acquiring additional coal assets. There may be even some asset swaps involved. So we are definitely focusing on resources and processing our resources. And
all within South Africa's borders, or are you looking at expanding further? Because looking at your cash reserves, I mean, they're up 57%, 31.5 million rand for the 6-month period to the end of September.
Yeah, and we're looking at investing in South Africa alone. What many people tend to forget is that in South Africa, outside of the Eskom and Sasol markets, there's still 16 million tons of coal available, which is consumed in the country on an annual basis. With the exchange rate as it is, with the export price as it is, the mining houses are focusing on export. So somebody has to slot into the inland market, and that is our focus. So we're remaining firmly entrenched in the inland market.
Let's differentiate between the two and look at that export market first of all, because you say a lot of the miners are focusing on that potential specifically, not so much given where export prices are, because they've softened to current levels of $106, but that the exchange rate is offering that significant premium, so to speak. To what extent is that supported by infrastructure? Because we know that has been a challenge in the past. Infrastructure bottlenecks that actually hinder the export potential.
Okay, TFR, I mean, it's always been quoted as the bad boy. But TFR, to my mind, over the last 3 months has really upped their game. They're railing coal at a rate they've never railed coal before. So we've already been advised that there's going to be a shortage of coal in the inland market next year for our consumption, because the mining houses are focusing more on the export market. As far as the pricing goes, yes, it has softened from around about $120 to $106. But at the current exchange rates back at the mine, that's still a significant premium on inland prices.
Yeah. Taking a look at the inland market then, and that's where, as you say, your focus is at this stage of the game, given that your bigger mining houses are looking at export potential. Where exactly is that demand coming through from? We know that your big clients are the likes of Eskom and Sasol.
Well, Eskom is our main client base. That's on the mining side. On the trading side, it's the manufacturing industry. Now, the manufacturing industry has been pretty flat. I mean, the manufacturing indices are not exactly shooting through the roof. However, with the mining houses focusing on the export market, they are to a degree withdrawing from the inland market, which allows us to increase our market share. So not necessarily an increase in volume consumption, but we will increase our market share.
And looking at that supply-demand dynamic that you mentioned in the inland market, how does that come to bear on the kind of pricing that you're able to put out there?
There's definitely upward price pressure on the inland market. In the end of 2008 and 2009 year, it was static. But since July and September this year, there's upward price pressures, and we expect another 16% before mid-year next year.
Let's take a look at the road ahead and your outlook moving forward for the company.
We want to establish a mine that's got a 15-year life, and we would like to do that in the next 18 months. We are trading under caution at the moment, so I can't divulge too much of it, but that is our goal, to have a fully fledged operational mine with a sustainability of 15 years.
You say 15 years. I mean, when you hear coal mining, you immediately think what kind of lifespan and investment this investment appeal, both in a context where you've got climate talks that are currently underway that certainly put the focus on clean, green energy down the road. What kind of investment appeal are we looking at here, and level of demand moving forward in your books?
Well, internationally, everybody's concerned about power poverty alleviation. And in all honesty, the only energy source that can alleviate power poverty is coal. But you've got to use clean coal technology, carbon capture and storage, and that sort of thing. So there is international investment in carbon capture and storage, but coal is still the main generator of energy in the world.